You are about to discover one of the best-kept secrets in the world of investing, a secret so powerful that it turned a country boy from the United States into the greatest investor of all time. His name? Warren Buffett. The method. A simple but absurdly effective strategy that earned him more than $100 billion. And the best part? He himself says that anyone can copy. But before I tell you how it works, let me ask you something. Have you ever tried to invest, followed all the hot tips on the market, and in the end, lost money? While many follow the herd and buy stocks at the top, Buffett does exactly the opposite. He has a golden rule: be fearful when others are greedy, and be greedy when others are fearful. And that one sentence explains why, when everyone was panicking in the 2008 crisis, he made $10 billion in just a few months. And it doesn't stop there. Buffett does not play the financial market lottery. He doesn't follow passing trends, he doesn't bet on the hot asset, and he never ever tries to predict where prices will go tomorrow. So how did he manage to grow his fortune for over 80 years straight without ever falling into any traps? The answer lies in a concept he learned as a child, and that allowed him to make his first fortune at 11 years old. Exactly. While other children were playing, Buffett was already investing. But how did an 11-year-old boy manage to start his journey to billions? This unbelievable story begins in the 40s, in a small town in the middle of the United States, and I'll tell you everything in 3 seconds. Stay with me, because this could change the way you invest forever. In the 1940s, in a quiet town called Omaha, in the state of Nebraska, a slight boy of just 11 years old walked into a stockbroker's office for the first time. His eyes sparkled as he watched a panel filled with numbers flashing red and green. That boy, Warren Buffett, was about to do something that would change his life. Forever. While other children collected stickers or played in the street, he had a clear objective: to buy his first share. And that's exactly what he did. At just 11 years old, Buffett bought 3 shares of a company called Citi Service Preferred, paying $38 for each. But soon after the purchase, the price dropped. The stock plummeted to $27, and Buffett began to feel the emotional weight of the market. He walked into the brokerage office every day, anxiously watched the numbers, and asked himself, did I make a mistake? It was a test of patience for such a young boy. But then the shares rose again. They came to $40. And what did he do? Sold everything. He made a measly $6 in total. Now, if this was your first experience in the market, you would probably be happy that you didn't lose money, right? But for Buffett, this experience brought one of the greatest lessons of his life. A short time later, he saw something that made him feel a real punch in the stomach. The stock he had sold continued to rise and hit $200 per share. If he had held on a little longer, his profit would have been 20 times greater. That kid learned, right then and there, a fundamental rule about investing: real money is made by waiting, not trading all the time. The birth of a financial genius. This wasn't the only time Warren Buffett showed he was light years ahead of his age. While many adults still struggled to understand how money worked, by age 6 he was already building a small business empire. Do you know how? He bought packs of gum and Coca-Cola in bulk and resold them for a profit to his neighbors. When he turned 10, his curiosity about investments only grew. He began devouring business books and, according to him, reads more than 500 pages a day to this day. But what really turned him into a genius was his obsession with financial statistics and patterns. He began following horse races closely and noticed that some bettors always won. What was the secret? They didn't bet on every horse. They analyzed histories, observed patterns, waited patiently for the right opportunity, and then they bet heavily on the horse with the greatest chance of winning. That was music to Buffett's ears. He realized that investing in the stock market was the same. Most people threw money into stocks without thinking, but he wanted to do it differently: analyze, understand the numbers, and only invest when he was 100% sure it was a good opportunity. This thought was fundamental to his future success. Buffett and his first profitable business at age 14, while his peers were focused on school and fun, Buffett decided it was time to expand his business. He began delivering the Washington Post newspapers every morning on his bicycle. And do you know what he did with the money he earned? He bought arcade machines and placed them in local barbershops. That's right. While the barbers cut customers' hair, the kids played arcade games, and Buffett kept part of the profit from each chip inserted into the machine. With this business, he was already making thousands of dollars a year. This was enough for, at the age of 16, he had saved $5,000, the equivalent of more than $60. 000 today. He then decided he didn't want to work for anyone. His plan was clear: multiply his money by investing, and that's exactly what he did. The great turn, the meeting with Benjamin Graham at age 19, Buffett entered the University of Nebraska and soon after enrolled at Columbia Business School. But it wasn't just because of the university's reputation. He had a single goal: to study with one of the greatest investors of the time, Benjamin Graham. Graham was the father of value investing, the strategy Buffett would forever adopt. He believed that if you bought a great company at a ridiculously low price, over time the market would correct that mistake and you would make a fortune. Buffett studied every word Graham wrote. And when he graduated, he did something that surprised everyone. He offered to work for his mentor for free, but Graham refused. Buffett persisted until he was finally hired. It was at that moment that he learned the secrets that would transform him into the greatest investor in history, the first big step towards billion. After years of absorbing everything he could from Graham, Buffett returned to Omaha and decided to create his own investment fund. He started small, managing money for friends and family, but quickly its returns surpassed all market indices. He used the same strategy he learned from Graham: look for undervalued companies, invest heavily and hold on to shares for decades. The result? Buffett's fund began to grow exponentially, and it was at that moment that he made one of the most brilliant plays of his career. He bought a bankrupt textile company called Berkshire Hathaway, but instead of insisting on the fabric sector, he used the company as an investment vehicle. From then on, Buffett began buying stakes in giants such as Coca-Cola, American Express, and Apple. And the rest is history. Now the big question: how exactly does Buffett choose the companies he buys? Is there a secret formula behind your decisions? And most importantly, is it possible to replicate this strategy today, even with little money? The answer is simpler and more powerful than you might think, and that's exactly what we're going to reveal in the next block. Stay with me, because this is the real secret of billionaires. Now that you know Warren Buffett's journey so far, the big question is, how does he choose the right companies? Is there a secret formula, a hidden code that only billionaires know? The truth is, yes, and no, Buffett doesn't use complex algorithms, nor does he rely on crazy predictions about the future of the market. His method is based on simple but extremely effective principles that he has followed religiously for over 60 years, and the best you can copy. So now let's unlock Warren Buffett's real secret. Get ready, because this information could change the way you invest forever. The fundamental principle: buy companies, not stocks. The first thing you need to understand is that, for Buffett, stocks are not just numbers flashing on a screen. When he buys a stock, he's not buying a ticker, he's buying a piece of a real business. He sees each company as if it were a physical store that he is acquiring. Think of it like this. If someone offered you a small restaurant for $100,000, you wouldn't decide to buy it based on what it was worth yesterday or what you think it might be worth tomorrow. What would you do? I would analyze the restaurant's finances. Does it make a profit or a loss? I would check the competition. Is there a McDonald's next door stealing customers? I would study the sales history. Is it growing consistently or is it declining? I would look at management. Does the owner know what they are doing, or is it a disaster? Buffett applies exactly the same reasoning when investing in publicly listed companies. It completely ignores short-term fluctuations and focuses on solid businesses with predictable profits and stable growth. The golden rule: only invest in companies. He understands one of the biggest mistakes beginner investors make is wanting to bet on trendy stocks without really understanding how the company makes money. Buffett never does this. He only invests in sectors and companies that he can explain in a simple sentence. Example: Coca-Cola sells drinks all over the world and makes absurd profits from it. Apple creates products that people love and can't live without. American Express businesses and consumers use its financial services daily. Now compare this to an experimental technology startup, which promises to revolutionize something, but no one really knows how or when it will make a profit. Buffett simply ignores these companies. He prefers to invest in predictable businesses and let time do the magic of compound interest. The valuation secret: buy cheap, hold forever. Here's one of Buffett's biggest secrets. It does not attempt to predict when a stock will rise or fall in the short term. What he does is wait patiently until an excellent company is being sold at a ridiculously low price, and then he buys heavily and holds on forever. Want a real example? In the 1980s, Coca-Cola went through a difficult time and its shares were too cheap in relation to the company's potential. Buffett looked at the numbers and realized the problem was temporary, so he bought $1 billion worth of Coca-Cola stock. Today, that investment is worth more than $25 billion, and he has never sold a single share. Why? Because the company continues to be profitable, predictable, and profitable. Buffett says the best time to sell a stock is never. If the business remains solid, it maintains its position regardless of market fluctuations. Buffett's 3 criteria rule. Now that you understand Buffett's general principles, let's simplify his method into 3 questions he always asks before investing. 1. Does the company have a consistent profit history? Buffett never invests in companies that don't generate money predictably. If profits go up and down like a roller coaster, he ignores it. He wants companies that, year after year, generate more money and distribute dividends. Examples: Coca-Cola, Apple, McDonald's, Johnson & Johnson. If the answer is yes, he moves on to the next question. 2. does the company have a strong competitive advantage? Buffett calls this a moat, that is, a protective moat around the business. This means that the company has something that prevents the competition from destroying it. It could be an extremely strong brand, a unique technology, or a natural monopoly. Example, Coca-Cola, globally recognized brand that is difficult to beat. Apple, closed ecosystem, loyal users who don't switch brands easily. American Express, prestigious name, accepted worldwide. If the company has this protection, Buffett moves on to the third question. 3. Is the stock cheap relative to its real value? That is Buffett's real secret. He only buys when a company is selling at a ridiculously low price relative to what it is actually worth. He says that if a stock costs $10, but he believes the company is worth $30, then he would buy it without hesitation. The problem is that most people buy stocks when they have already risen a lot because they are influenced by the media and hype. Buffett does the opposite. He waits patiently for a discount in the market, and when that moment arrives, he buys heavily. The moment Buffett makes money. Now, there's one thing most people don't understand about Buffett. Most investors think that money is made when you buy a stock and it goes up, but Buffett doesn't think so. He says money isn't made in selling, it's made in buying. That is, if you buy cheap enough, profit is inevitable. The market can take years to realize the real value of a company, but when that happens, the stock price soars, and Buffett reaps the rewards. Now you know how Buffett chooses his stocks, but there is one detail that almost no one talks about. What does Buffett do when a stock he bought starts falling? Will he maintain his position? Or does he know something we don't and sell it before the disaster? In the next block, we will reveal Buffett's real secret during market crises and crashes. And what did he do to make billions while everyone was panicking? Get ready, because this could change the way you invest forever. Now that you know the principles of Warren Buffett's method, the big question arises: how can you apply this in practice? Is it possible to invest like Buffett, even without millions of dollars available? The answer is yes. And now I'm going to show you a practical step-by-step guide so you can get started today. If you follow these strategies the right way, you can start building a profitable, safe, and crisis-resistant investment portfolio, just like Buffett does. So grab a pen and paper, because this could change your financial life forever. Step 1. Identify excellent companies. Before buying any stock, the first thing you need to do is identify companies that have characteristics similar to those in which Buffett invests. This means looking for companies that have consistent profits, companies that make a profit every year without major fluctuations, strong brand and global recognition, companies that dominate their sectors. Competitive moat, something that protects the company from competition. Controlled debt, companies that do not depend on loans to survive. Now the question is, how do you find these companies? Fortunately, there are free tools that can help you analyze this quickly. Yahoo Finance to check company numbers. Investing, Calm to compare competitors and look at financial indicators. Morningstar for more detailed analysis on valuation and fundamentals. Let's take a practical example. If you go to Yahoo Finance and search for Coca-Cola KO, you'll see that the company has had decades of growing profits and has been paying dividends for over 100 years. This means it fits perfectly with the Buffett style of investing. The same goes for Apple, Johnson & Johnson, McDonald's, and American Express. Step 2. Wait for the right time to buy. Now that you've found a great company, comes the hard part. Wait patiently for the right time to buy. Buffett never buys stocks when they are expensive. He expects crises, market crashes, and financial panics, because these moments make shares of big companies ridiculously cheap. This is how he bought it. Coca-Cola 1988 during a time of uncertainty in the market. Goldman Sachs 2008 in the middle of the financial crisis when everyone was selling. Apple 2016 when shares were undervalued. What does this mean for you? If a company is expensive, simply wait, and when the market panics and drives the price down, buy hard. Step 3. Know the real value of the company. Now, here is a very important detail. Buffett doesn't buy a stock just because it drops in price. He buys because the stock is trading for less than it is actually worth. But how do you know if a share is cheap or not? To do this, Buffett uses an indicator called P or L, price to earnings. Rule of thumb, P or E less than 15, the stock may be cheap. P or E between 15 and 25, the stock may be fair. P or E above 25, the stock may be expensive. Practical example, if a company like Apple has a P or E of 10, it means it is very cheap relative to its earnings. If it has a P or E of 40, it means the market may be overly optimistic and it may be expensive. Buffett always buys excellent companies when they have a low P or E. So before buying any stock, check the P or E on Yahoo Finance or Investing. Calm. If it's too loud, wait. If it's low, take advantage of the opportunity. Step 4. Hold on to stocks for decades. Here's Buffett's biggest secret. He doesn't try to make a quick buck. While many people buy stocks and sell them shortly after a short high, Buffett does exactly the opposite. He buys and holds for decades. And why is this so powerful? Because this allows him to take advantage of compound interest. Real example, Buffett bought shares of Coca-Cola in 1988 at a low price. If he had sold it 5 years later, he would have made a good profit. But because he held the shares for more than 30 years, the original $1 billion investment turned into more than $25 billion. This shows that the real money is made in the long term. If you want to invest like Buffett, don't sell good stocks just because the price has gone up a little. Think like a business owner. If the business continues to generate profit and grow, there is no reason to sell. Step 5. Reinvest dividends. Buffett loves investing in companies that pay dividends. This is because, in addition to the appreciation of the share, he receives extra money every year without having to sell anything. What does he do with these dividends? Reinvest in new shares. This effect makes your assets grow exponentially. Real example. If you had invested $1,000 in Johnson & Johnson in the 1980s and reinvested the dividends, you would have more than $200,000 today. Therefore, a smart strategy is to buy solid companies that pay dividends and use that money to buy more shares. Over time, your wallet will grow on its own without you needing to add more money from your own pocket. Now that you know how to apply the Buffett method in practice, a question arises important. If this strategy is so powerful, why do so many people lose money investing? And more. Has Buffett ever made mistakes? Has he ever lost money with any company? The answer is yes, and in the next block, we'll reveal Buffett's biggest mistakes, the times he broke his own rules and what we can learn from it, and most importantly, how to avoid these mistakes and protect your assets for years to come. Stay with me, because this might be the most important part of the video. Now that you know how to invest like Warren Buffett, an important question arises: has Buffett ever made mistakes? And the answer is yes. Even though he is considered the greatest investor in history, Buffett has already lost millions, even billions, with some bad decisions. But the difference is that he learned from every mistake and used those lessons to become even stronger. So now, let's look at Warren Buffett's biggest mistakes and what you can learn from them to avoid losing money in the market. And at the end, I'll show you what Buffett would do if he were starting to invest from scratch today. Pay attention, because this part could be worth thousands of dollars to you. Mistake number 1, buying bad companies just because they were cheap. In the 90s, Buffett made a mistake that he himself says was one of the worst of his career. He bought $358 million worth of stock in a company called Dexter Shoes. At the time, Dexter seemed like a good investment because the stock was ridiculously cheap, but there was a problem. The company did not have a competitive moat. It relied on an outdated business model and was unable to compete with shoe manufacturers in Asia. Result: a few years later, Dexter Shoes went completely bankrupt, and what was an investment of $358 million literally became $0. Buffett even said in an interview, "I could have taken that money and thrown it in the trash and the result would have been the same." Lesson: don't buy companies just because they look cheap. Buffett learned that low price does not mean opportunity. If a company does not have a strong competitive advantage, what is cheap can be very expensive. Mistake number 2, waiting too long to buy excellent companies. Another mistake Buffett made several times was not buying amazing companies at the right time. He has always been an extremely disciplined and patient investor, but sometimes this patience has caused him to miss great opportunities. For example, in the 90s, he could have bought Amazon shares for a very low price, but he didn't buy it because he thought the technology sector was too uncertain, and what was the result? Amazon has become one of the most valuable companies in the world, and Buffett admitted it was one of the biggest mistakes of his career not to invest early. The same happened with Google, Microsoft, and Tesla. Buffett only started investing seriously in technology very late, when prices were already high. Lesson: when you find a great company, don't delay in taking action. If a company has strong growth, solid profits, and a competitive moat, don't wait forever thinking the price will drop even further. Buffett realized that it is better to pay a fair price for an amazing company than a low price for an average company. Mistake number 3, trusting some people too much. Buffett has always been a master at choosing competent CEOs who manage Berkshire Hathaway companies. But sometimes he trusted the wrong people, and it cost him billions. A famous example was the company Salomon Brothers, an investment bank in which Buffett bet heavily. In the 1990s, the bank fell into a major financial scandal, and Buffett was forced to personally intervene to prevent a collapse. He managed to save the company, but the stress and losses were enormous. Buffett learned that even large companies can be destroyed by poor management. Lesson: always evaluate who is in charge of the company. Before investing, check the background of the CEO and executives. If they have made serious mistakes in the past, beware. A good management team can transform an ordinary company into a giant, but bad management can destroy even the best companies. How would Buffett invest if he were starting from scratch today? Now, the big question, if Buffett were starting from scratch today, how would he invest? Here's what he himself recommends for beginning investors. 1. Invest in the S&P 500 index. Buffett always says that most people don't need to pick individual stocks. If you don't want to analyze companies all the time, simply invest in the S&P 500, the 500 largest companies in the US. This already puts you ahead of 90% of investors. 2. Buy shares in great companies and hold for decades. If you want to invest like Buffett, choose companies with consistent growth and a competitive advantage, and hold for many years. Examples he likes: Apple, Coca-Cola, McDonald's, Johnson & Johnson. Buffett always says, time in the market is more important than trying to predict the market. 3. Ignore news and market panic. Buffett never makes decisions based on fear. He ignores predictions, crises, and alarming headlines. If the market falls, he sees it as an opportunity. If you learn to think like this, you will be able to stay calm and invest intelligently. Warren Buffett became one of the richest men in the world by following simple principles. He never tried to predict the future. He never bet on the fashion asset. He never followed the crowd. What he did was buy amazing companies and hold on for decades. And now that you know exactly how he does it, all that's left to do is put it into practice. Now, before you leave the video, I want to know, do you already invest? If yes, in which companies? Comment below and I want to see your strategy. And if you like this video, subscribe to the channel and activate the bell. Because in the next video, I will show you the secret investments that Buffett has made in recent years and what this could mean for the future of the market. See you in the next video.